Hi, good evening. Today we'll discuss about the inventory valuation in the financial statements. Um, in the financial statements, when we have closing inventory at the end of the period, the inventory which is in our company is to be valued using a method called LCM. LCM method. LCM method stands for lower of cost or market value. Lower of cost or market value. So here you know that there are two prices. One is cost price, which you paid at the time of purchase. The cost price may be different from the present market value. Okay, say for example, today is March 31st. We are closing the books. We have some units. In the month of October, we purchased 1000 units, okay, at the rate of $25. At the rate of $25. From this, we sold 800 units. During November and December, we sold 800 units. Now this 200 units value is to be used in the computation of two things. One is COGS. When I know the value of cost these 200 units unsold, I can find out cost of goods sold, and also I can show in my current assets. To know these two, I should know what is the value of this inventory. I know the cost price at which I purchased in the month of October. And what is the present market value? I have the present market value with me, which we call it as fair market value. Fair market value means at the moment what is the value of these goods. In actual, we should know these two, and least of these two should be taken into account. Either cost price or fair market value. So what we understand today is the cost price is already given. Find out the fair market value of the unsold goods. Then least of these two should be taken into account. Cost or fair market value. Lower of cost or fair market value is to be taken into account. Cost. Cost is the amount which is paid by me at the time of purchase of this inventory. But if I buy now today, what is the price is called as CRC, current cost replacement cost. CRC means current cost of replacement or current replacement cost. Say for example, I purchased on October 1st at the rate of $25. This is my purchase price. Today I can sell it for $32. This is the present market value. Today is 31st December. Are you with me all? Today is 31st December. This is called fair market value. But what is the purchase price if I purchase today? My purchase price is different. My sales price is different. If I purchase today, it could be say $27. This is called as current replacement cost. Current replacement cost. This is the price I paid to purchase it long back. The inventory is still with me. This is current replacement cost. This is the current market price, fair market value. Now you know, I think. Cost price. This is CRC. This is fair market value. Okay. So cost price, which I actually paid at the time of buying the goods. Current replacement cost today, if I buy from my supplier, this is the price. And fair market value, this is my selling price, because my selling price is different from my cost price. My cost price is different, my selling price is different. So far we have now three costs: cost which I paid, cost if I purchase now, and the price which if I sell it now. Okay, so now let us consider one more thing. What is that? Market price. This is a fair market value. Next, one more is net realizable value. In my previous example, I gave you three prices: one, $25; two, $27; three, $32. This is my cost price. This is current replacement cost. If I buy today, what is the price? And this is my fair market value. Today, what is the selling price? But to sell these goods, I may have to spend some money, that is called like either salesman commission, selling expenses, etc. etc. When I deduct the selling expenses, I get NRV. NRV. So my NRV is $30 here. My NRV $30. Any disposal expenses, selling expenses are deducted from fair market value. I get NRV. In NRV, I have a normal profit of $5. When I purchase $25, I am selling with $30. I have a profit of $5. When profit is reduced, deducted from NRV, we get floor. This is called floor. So please remember all the five components: cost price, current replacement cost, NRV. NRV is also called as ceiling. Ceiling. NRV or ceiling both are same. And from NRV, when you deduct normal profit, we get floor. 1, 2, 3, 4. So under GAAP, we consider these four costs to find out the value of ending inventory. Whereas under IFRS, we just compare list of these two, cost and fair market value. So we are using GAAP, therefore we should follow these calculations. What are they? These calculations. Please note down this. If current replacement cost, RC means replacement cost, current replacement cost is greater than ceiling. Ceiling means NRV. Ceiling or NRV both are same. If current replacement cost is greater than ceiling, our fair market value will be ceiling. Ceiling is nothing but NRV. If ceiling is greater than RC and RC is greater than floor, our current market price will be replacement cost. That is, floor means NRV minus normal profit. Whereas if floor is greater than replacement cost, our market price will be floor. Listen carefully. From any of these, you are going to find out fair market value. Then cost price is waiting for you here. You find out any one of them as fair market value, and this will be compared with the cost price, and use LCM, lower of cost or this market value. Cost or market value. How did you find this? With the three conditions. Any one of three conditions will be met. Any one of these three conditions will be met, and you find out fair market value. This fair market value is to be compared with the cost price, and there after the comparison you pick up lowest of these two. Okay, very important, please. Now let us have a small exercise here. I have some inventories. I have some inventories here with me. So let us compare the market price with the cost prices and find out what value is to be taken into account. Now here, let me work on product A. Product A says the price of product A when we purchased is 10.25. 10.25. 10.25 is giving me a cost price, whereas 9.5 is the market price. So when you compare 10.25 of product A with the market price 9.5, lower of them is 9.5. So 400 times 9.5 is 3,800. 400 times 10.25 is 4,100. So I will take 3,800 here. This is going to my financial statements in the calculation of cost of goods sold and the ending inventory. Here when we observe here product B, I have 120 units on 31st December whose cost price was 22.5. Now the market price is 24.10. Use LCM, lower of cost or market, 22.5 times 120, 2,700. 120 times 24.10, 2892. Compare lowest value 2,700. Likewise, product C 4,650. Product D 3,920. Now, if you observe here, my cost price was 15,000, 15,520. When I purchased, my cost price was 15,520. Whereas now the value I'm going to take in my financial statement is 15,070. See the difference between these two. There will be a inventory revaluation cost of $450 loss, which should be adjusted in the books this year by showing this amount as closing stock, closing inventory. This will go to our uh, uh, comprehensive income statement, and this should go to balance sheet as closing inventory. Comprehensive income statement will be adjusted with $450 because my cost price was 15,520. Likewise, we'll have one more exercise here, small exercise. Product C, we have 10 units, purchased at $39. Now the market price is 40. So I should take 39. Product B, we have 7 units. Cost price was 110, but the market price is 98, which is lower of these two. So 10 times 39, 7 times 98 is the value we are going to consider in the financial statements. That is 1076, whereas the cost price of these 17 units was 1160. The difference is to be calculated and taken in comprehensive income statement, but in the financial statements you will have only the inventory value of 1076 in the balance sheet and the cost of goods sold calculation. Now further we also practiced that how to calculate fair market value from these three scenarios. Any one of the scenarios will be met and you will find out the market value, and cost price is waiting for you here. The result of scenario 1 or scenario 2 or scenario 3 should become your market price here. Then compare with the cost price, find out lower of this. Okay, not directly like that. So if replacement cost is greater than NRV, NRV means ceiling, your market price will be NRV. You take NRV here, compare with the cost price. Whereas if NRV is greater than replacement cost and replacement cost is greater than floor, your market value will be replacement cost. So in that case, replacement cost will become your market value compared with cost price. Whereas if the floor is greater than replacement cost, your market price will be floor. So that floor will become market price here compared with cost price. Never take this cost in these calculations. Cost is to be kept separate, waiting for to be compared with the market value, which is found from any one of these scenarios. Now I'll give you some scenarios here. We need to find out the market price and compare with the cost price what is to be taken into account. Yep. Yes. Inventory errors. During the valuation of inventory, if there is an error in the inventory, that will have an impact. The error will have an impact on the financial statements. The profit either may increase or may decrease. Let us now practice what happens if there is an error in the inventory. Okay, as we know that cost of goods sold can be calculated with the help of this formula: beginning inventory plus purchases minus ending inventory gives us sales. Oh, sorry, cost of goods sold, which is compared with the sales to find a gross profit. Now let me give you this with a sample of calculations. Now beginning inventory, this is original data. Original data, beginning inventory 5,000, purchases say 12,000, 17,000 total, ending inventory 3,000. What is the cost of goods sold? Cost of goods sold is this much. Now we have sales here. Sales, say for example $20,000. So when you say this is 14,000, okay, 14,000, and the sales is 20,000, your gross profit is the total of this. Okay, your gross profit is 6,000. If gross profit is higher, net profit will be higher. If net profit is higher, okay, retained earnings will be higher. If retained earnings are higher, equity will also be higher. Okay, say for example, now original data is this. Say for example, error, there is an error. Error, what happened here in the error? This what happened. Beginning inventory was 5,000, but now it is overvalued. Beginning inventory overvalued 6,000. What happened here? Gross profit decreased. So here beginning inventory was overvalued. What happened? Cost of goods sold increased. Okay, now gross profit, GP, NP, retained earnings and equity. What happened to this? Decrease. When beginning inventory was overvalued, the impact on cost of goods sold is cost of goods sold will increase, and all gross profit, net profit, retained earnings equity will be decreased. If the same data is done the other way, see with the practicals here, this is error. Okay, this is again error. Error is that we used only 3000 here. This was 5000, but with error it has become 3000. So cost of goods sold is reduced, gross profit increased. So beginning inventory was undervalued. Undervalued. Gross profit decreased. Cost of goods sold decreased. Gross profit increased. This is the impact of an error in opening inventory. Okay. What happens if the ending inventory is overvalued? Ending inventory is overvalued. This is 5000 original data. Ending inventory is overvalued, minus 4000, supposed to be 3000. So ending inventory was overvalued. What happened to cost of goods sold? Cost of goods sold decreased. Decreased. And GP, etc., increased. Yep. What happens if ending inventory is undervalued? If ending inventory is undervalued, instead of 3000 it is 1500. My cost of goods sold increased, gross profit decreased. Ending inventory was undervalued. Cost of goods sold increased and GP, NP, etc. what happened? Decreased. Okay, so don't learn it as a formula. As I shown you, with the numbers you experiment it in the examination, having just half a minute is more than enough to come to a conclusion. It's a full-fledged question. He will ask you, giving you sales, beginning inventory, purchase, etc. And also he will give you the error information. Based on this, just do this calculation and you will come to know this information. Don't get confused in the examination. Please take your own time and find out the profit. Though the numbers are not given, sometimes a theory question may be given. If theory question is given, still use some numbers, small numbers. Don't take millions, small numbers. Even you take 2000 here, 500, 1200, 300. We want to know the impact practically. So to make sure that your answer is right, have some number calculations. Yep. So let us also learn the weighted average method of cost flow here. We learned so far FIFO, LIFO, first in, first out, last in, first out. This is the scenario. These are the dates, purchases, sales, and these are the rates, selling price. Okay, quantity, etc. is recorded here. Opening balance. Opening balance, beginning balance on March 1st is 1000 units at the rate of 2. This is from here. Yeah. Uh, purchases. We purchased 2000 units, 2.5, 5000. The importance of this method is never maintain the history like this. What you need to do is add quantity to the quantity purchased, add value to the value purchased. So let me remove this previous calculations. Yeah, we had a quantity of 1000 units before this purchase was made. Now I have 1000 units previous balance plus 2000 units, 3000 units total. Likewise, This is the value of the goods just now we purchased 5,000 plus this is the value of the goods beginning balance. So 5,000 plus 2,000, 7,000 units. And find the latest price which is weighted average. So the total value divided by total quantity. Total value divided by total quantity. So 7,000 over 3,000 will give you 2.33. So take round figure, two digits, it's more, it's okay. 2 digits. Yeah, 2.33. So what rule is to be applied? Add quantity to quantity, value to value, and find the latest price by dividing the quantity, dividing the total value by total quantity. Second we purchased, it's done here. Third we sold. How many units? 2,500. No step down method like this. Don't use all this. How many units are sold here? 2,500. Just take total quantity. Deduct quantity from the total quantity and use the same rate 2.33, that is 2.33 times 2,500, 58825. Now apply the rule, same like purchases, here sales. Deduct quantity from the total quantity. Deduct quantity from the total quantity. So we had 3,000 units minus 2,500. Okay. And also deduct value from value. $7,000 minus 5,825. Okay. Now what you can do is find out the price. You will get the same price. Only when you newly purchase with a higher rate or lower rate, you will find out new price. Here you will see almost same price, 2.35, because of the fractions. Almost same. Fine. So 2,500 at the rate of 2.33, 5,825. Now 500 units left. Next, on the same day, we purchased as well. Purchased how many units? 3,200 at the rate of 2.8, amount 8,960. Now what you need to do is you need to add quantity to quantity. Add quantity to quantity and value to value. This I will remove not to have any confusion. Okay. Yes. Now 500 units here and recently purchased quantity is 3,200. So total is 3,700 units. At the same time, I have a value of 1175 value of goods, and now recently purchased is 8960, 10,135. Now find the latest price, 10,135 over 3,700, 2.74. 2.74 is going to be my next issue price. Okay, then purchased again on 4th of March, 4,500 at 3. So 4th of March purchased how many units here? 4,500 at $3. So 13,500. 13,500. 13,500. Now the same rule again. Add quantity to quantity, value to value. 3,700 plus 4,500. 10,135 plus 13,500. Find a new price, 2.88. Then the same day we sold goods, 4th of March we sold how many units here? 3,200. No need to give bifurcation here. What you can do is you can just take down this. What is it? 3,200 units. 3,200 at the rate of 2.88, and the value will be, yes, 9216. Now deduct quantity from quantity, value from value, you will get the same price almost. Only some difference, there's no difference also. Sometimes you get some, small difference. So this is the quantity I have here. Next, fifth purchased 1200 units. Fifth purchased 1200 at 3.5, 4200. So 5000 plus 1200, it is going to be 5700. 5000 plus 1200, 6200. And the value will be 14,419 plus 4200. And now find out the latest price. Yes, $3. Now we sold 2500 units. Same date, 5th, sold 2500 units. 2500 units. 2500 at the rate 3, 7500. Now deduct this amount. Deduct this amount, 6200 minus 2500, 3700. Yes. And 18,619 minus 7,500. Then find a new price. Okay. So your ending inventory will be same. Quantity will remain same. Okay. And value will be different. Closing stock will be different. Here $11,119. Okay. Let me check what is the difference in the profits as well. Details. We'll copy details here. Yes. Here 22,541. Ending inventory 11,119. 3,700 is matching. Then cost of goods sold, gross profit, sales 41,000. 8,200 times 5 and 22,541, then 18,549. 18,549. Before there was a profit of 90,040. Okay, so profit will also be different. Ending inventory value will also be different. This is the method we use under weighted average method. This is the steps you need to follow. Just update the inventory every purchase, every sale.